This is exactly how to find sniper entries every time and go from taking trades like this to high reward to risk trades like this. Let's start. So the first thing we want to start with is understanding how do sniper entries look like. Now, a lot of people are going to look at this and then say, you know, this is not logical because what you're doing here is taking this very tight stop loss and then going all the way down, doing the same thing here and then going down. But this is very logical, and this is how, you know, when you apply the two methods that I'm going to go over, maybe one of these or two at a time, you can actually achieve trades like this. Now notice how whenever I take a trade, what I'm doing is I'm entering with a very tight stop loss. Usually you'll be taking a trade like this with the same take profit, but the stop loss is going to be a bit bigger, something like this. Now, when you go and tighten the stop loss more and more, you're going to have much bigger reward to risk. So this is the exact same chart as before, but for this time, we're not focusing on a sniper entry. We're just taking, you know, what usually 90% of the traders do is looking for more and more and more confirmation because they're not trusting the plan and they don't know exactly how to find these precise key levels and how to have these sniper entries. So notice how on the previous one we've taken a trade here with a very small stop loss, but now we're waiting for more confirmation and then a bigger stop loss, maybe the same take profit. But notice how when we have a late entry and then more confirmation and then it's going to lead to a bigger stop loss, and now it's only about 1.5 to 1, for example, and here it's 2 to 1, and here it's 3 to 1 instead of 10 to 1 and 7 to 1 and sometime, you know, 15 to 1. Now let's focus now and go deeper into the sniper entry. What are the components of a sniper entry? The first one, and this is the most important one, is the stop loss. The stop loss should be as tight as possible. You know, stop loss, what is it? It's the invalidation point. If my invalidation point is too big, that's going to lead to a very weak and very small reward to risk. So we want to make the stop loss as tight as possible. The second one is going to be the take profit. The take profit should be also as big as possible. Whenever you have a very tight stop loss and a very big take profit, that's going to give you a high reward to risk trade. And, you know, looking at the stop loss also, that's going to lead to a sniper entry. Now, I want you to see the difference between these two here. So this one and this one here. This one is almost 10 to 1. So it could be 9 to 1, I don't know, 11 to 1. Notice how small the stop loss is. Even though the take profit is the same, we did not actually adjust the take profit here. How much the stop loss size affects the reward to risk. So here, a very small stop loss is giving us the sniper entry. Now we'll learn how to actually take trade like this. And then the 1 to 1, also the difference is that we wait for a lot of confirmation and then we take a trade and then we cover the low, and it's gonna be, you know, after a big move happen, then we enter. So we're not trying to do this. Now, one thing I want you to understand here is the effect of a stop loss. The moment you take your stop loss cut, or, you know, your lower stop loss by 50%, instead of, you know, 20 pips, I would do 10 pips, and the reward to risk was 2 to 1. So it was 2 to 1. Whenever you cut your stop loss by half, that reward to risk is going to be now 4 to 1. So it doubles. You know, cutting the stop loss by 50% is going to equal to doubling the reward to risk. So that's the main intention here. I want you to focus more on the stop loss. The question that you're having here, maybe you're asking, okay, Moham, why are we actually focusing on high reward to risk? Because there is a relationship between reward to risk and win rate. The more reward to risk we're going to be focusing on, and then based on our trading plan, the easier it's going to get for us when it comes to the win rate. We need a lower win rate to actually become break even and to make more money. This is the win rate here, and this is the reward to risk. So now if you're targeting 1 to 1, now usually I do use, you know, the opposite here. I would go 9 to 1 instead of 1 to 9, but it's the same idea here. So 1 to 1 means that I'm risking $100 in order to make $100. That's it. Now you need 50% to make money, and most of you know this. But now the more reward to risk you get, the easier it's going to be for you, the lower win rate you need in order to become profitable. So notice how you need only 20% win rate in order to make money just by having 5 to 1 or 1 to 5. I'm risking only $100 in order to make $500. Then all I need is what? 20% win rate in order to make money. So let's say we have a winner, loser, 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 so 4 losers, and then a winner, and then 2 losers. That's going to equal to what? 5 reward to risk from this one if you're focusing on 5 to 1 here, and then 4 losers here, minus 4R, a winner, so that is 5R, 2 losers, that's minus 2R, and that's going to equal to plus 4R at the end. So notice how you lost how many times? You actually lost 6 times, and you won 2 times, and you are still in 4% profit if you're risking 1% here. Now, some of you might be saying, you know, this is illogical, but this is what I actually teach in Edge School. It's all about, you know, a universal model called the Edge model, where we focus on high reward to risk, and then we focus on the quality other than the quantity. So these are some examples of the Edge model. If you notice, we have insane 33 reward to risk, and then sometime 5R, and this is all shared before the setup happening, as well as here 12 reward to risk, 18, and then 9. All of these are some of the winners that I share on Edge School using the Edge model. So if you're curious and you want to learn more and trade like me, I'll see you on the inside at edgeschool.net. Now, to be honest here, there are many ways to find sniper entries or, you know, to have high reward to risk, but I will teach you are 2 universal methods that you can actually use and apply them to any strategy. So when I say universal, that means it is applicable to anything that you trade. You can be creative here. You can go outside of these, you know, think out of the box, go outside of these 2 methods, and then think about how you can actually apply this to your own setup. Now, the first method is the 2 key levels, and the problem with a lot of people, so let's say we're thinking about a fair value gap. What a lot of people would do is look at this fair value gap, and they're only predicting, looking at this single fair value gap, and they're looking for price to go lower. But again, price could go anywhere inside the fair value gap, right? So if I'm looking at a daily and then looking to enter off an hourly confirmation, then price could actually go anywhere. It actually can go inside here, give me a confirmation, and then go again inside, give me another confirmation, and that's going to be the cycle. So there is no precise level that price could go to and reverse. I don't know exactly, it could go anywhere inside it. Now, if we're looking at an SNR level, for example, so support and resistance, in this case, a resistance, price could go anywhere inside the resistance level. That's one of the examples. So I don't know exactly where it's going to go. In this case, we're only focusing on what? A single key level. So I'm looking at a fair value gap. I'm looking only at an SNR. And sometimes you could look at an order block here. You could look at anything. Now, this could also apply to what? Liquidity. Liquidity, where we have a high, for example, price could go anywhere above the high. So it could take the high just by a small wick. It could also do this all the way up. So how do I know? Also this one here, it could go just inside it. It could go somewhere in here. And the same applies to the fair value gap. It could go here or maybe here. Fill the whole fair value gap. So the thing is, instead of using a single key level, we don't know exactly where price is going to go to. What we need to do is use 2 key levels. That's the approach that we're going to be taking. So instead of just focusing on liquidity, I could do a fair value gap and liquidity. I could do a fair value gap and SNR. I don't know, SNR and liquidity. So, or this could be to any key level. So I could do an order block and another key level. I don't know, anything. Use some combination of these. I'll give you things that actually work. 2 approaches. But the thing is, instead of focusing on 1 key level, where I know that an imbalance would push price lower, right? But I don't know from where. But the overlap of 2 key levels inside the imbalance and the other key level, the overlap, I know this is the highest probability level. This is where a lot of time I'm going to be having the sniper entry. So this is how we think. We're looking at 1 key level. I mean, it could give a reaction here, here.